Welcome to yet another episode of Shortcast over coffee. Today, my guest is Professor Aswath Damodaran. He's a professor of finance at the Stern School of Business at New York University, teaching corporate finance and valuation. He's dubbed the Dean of Valuation, but calls himself more of a dabbler who teaches because he loves it. Check out more about his content in the links in the description. But without further ado, Professor Ashwath, thank you so much and welcome to the podcast.
Thank you for having me.
Before we get to the good part about corporate and finance, I wanted to ask you. I read a very interesting line on your website that says, quote, I am at the intersection of three businesses: education, publishing, and financial services. They are all big, inefficiently run, and deserve to be disrupted. What is it that is making it run so inefficiently, and what are your thoughts on how best to disrupt it?
When the one of the indications that a business is in trouble and deserves to be disrupted is nobody is happy. The business companies are not happy, the customers are not happy, the rest of the world is not happy. I could have added healthcare to the list, right? Healthcare in the US is a bad business. Nobody's happy. The insurance companies are unhappy, the doctors are unhappy, the patients are unhappy, because there's something wrong in the process. And the three businesses I described, I'm not in the healthcare business, I'm going to keep it out of the picture. The three businesses I described all share that characteristic, which is they're all in some kind of trouble, right? Let's take education. Education, over at least in the US, has evolved into a non-profit business for the most part. Right? Other parts of the world, that's not true. In India, for instance, it's a for-profit business. But I think the word nonprofit covers up a reality, which is there's a pie. People are getting slices of the pie. The only thing about it in being a nonprofit is there's no residual claimant. That's really the difference in a for-profit and nonprofit. And in many ways, that's been the cover for nonprofits. Is we're a nonprofit, so why would you even ask us about our expenses? It's become a cover for all kinds of inefficiencies. Right? Publishing is a different problem. I deal with publishers. They frustrate me because they're stuck in the 20th century. Now, I'll give you an example. Now, and I'll pick the name of one of my publishers because I want to shame them. It's John Wiley. John Wiley is a publisher of four of my 12 books, five of my. I have no problem with them as a publisher. They're a decent publisher, but they take actions. They sometimes look at it and say, are you guys in the 21st century with me, or am I just in the wrong century? I'll give you an example. About 7 years ago, I get an email from them that they've decided to withdraw the Indian editions of my books. Here's the way the Indian edition used to work with Wiley. They'd publish a US edition. They'd price it at $100. Why? Because the market was willing to pay that price. And then they'd publish the same book, exactly the same book, on cheaper paper with maybe a paper cover and published in India for $20. In rupee terms, it was still a lot of money, but not as much as $100. And I said, why would you do this? This is really the largest English speaking market for my book. If you think in terms of growth potential as a business, you've taken your biggest growth market out of the picture. Because there's no way a university in India can assign my book at $100 and expect students to afford it. And their answer was, it's cannibalizing sales. And I said, tell me more. They said, well, there are people who are buying the Indian edition instead of the US edition who live in the US. And I said, well, how many books have been cannibalized? And they said, we don't know, but we know that at least some people have been doing this. So I said, let me get this clear. You're shutting down your biggest growth market because an unspecified number of books are not being sold because you chose not to. And I said, do you realize the effect of doing this? And they said, what are you talking about? I said, no, I sent them a tweet that somebody had sent me of them coming out of a train station somewhere in India and finding one of my books out there for, I think, 600 rupees. And it was really not, it was a John Wiley book that somebody had pirated, printed on their own paper. And I said, you know, this is exactly what's going to happen, right? You cannot stop it. So The question you have to ask is, so would you rather cannibalize yourself, or would you rather have this guy in the train station in India cannibalize you? And you seem to have chosen the latter. And they just didn't get it. And this, I run into the same issue in publishing when they publish a Kindle version of the book. Every publishing company, if you look at their Kindle version, it's just a physical book converted to Kindle. And I said, you're missing the whole point of it being in a Kindle or an iPad. You're online. You know, all these chances you're missing, right? All those things can be live. In fact, why would you ever need new editions of books? You can have books that actually update themselves online. And they said, we can't do that. It'll disrupt our business model because we need new editions. And I said, guess what? This is exactly the kind of business that Amazon right now can look at and say, we could do this cheaper, we could do it better. And you're going to get disrupted. And you say, what the heck happened? It's publishing. Financial services, banks, and I know it's a long answer, but I would have their own layers of inefficiency, right? They were built in a different age for a time when people actually walked into banks to do that. I mean, I look around the towns and cities that I visit and I look at the number of physical bank branches. And my question is, I haven't been inside a bank branch and I don't know how long. What am I going to do? Go ask the bank teller for investing advice or banking advice? I mean, what am I going to do? So I keep asking, why do they keep building these physical spaces when people are not physically going in? I've never seen a crowded bank or a line at a bank, unless it's a bank run, which is a very different problem. But banks again operate with these layers of inefficiency being built up over time. I mean, I remember when I had to move my money from New Jersey, which is where I used to live, to California. I was using JP Morgan Chase in New Jersey. And I wanted to move my money from that branch to my branch in La Jolla, California, which is where I live. Same bank. All they have to do is move the money. They charged me $60. And I called the bank and said, what is this $60 for? It's for a wire. And I said, what exactly are you guys doing? Taking the money out of the bank as cash, putting it in the back of somebody and sending them across the country? What is costing you $60? The answer is absolutely nothing. They do it because it's a business model. And as long as it works, why would they stop doing it? No. Why do you think outfits like Venmo and PayPal have exploded? It's precisely because there's fat in the banking business that those businesses are essentially taking over. It's going to, if banks don't have that soft business, though, they'll have a tough time surviving as banks. I worry about the health of banks because they require these $60 bank wires to keep going for them to be able to do what they do in the rest of their business. So, long answer, three businesses, all inefficient. I am not, I don't have enough of an ego to believe that I have enough pull to alter any of their trajectories, but I'm going to do everything I can in my power to disrupt all three.
Yeah, you write in your website how you're mad at how publishers make your books very, very expensive, and you're doing everything to lower the prices, and you absolutely hate it. And about the banking industry, like even sometimes I wonder, like there was some charge of like $7 because my account in my checking account or my savings account, I can't quite remember, went below $1,000, and I'm like, why are you charging me this fee? And it just went unnoticed for a few months until I realized it, and it was too late. But yeah, um, I recently heard Gary Marcus say that OpenAI is overvalued at $175 billion. More so, he goes on to say how in AI, the intellectual property is the only moat, and that startups make it hard to quantify the valuation companies compared to companies with traditional assets. Um, do you agree with this statement, or what is your take on
There
this?
are three parts to that statement. I have different degrees of agreement or disagreement with each one. First, he started with did he say 875 billion? So first
100.
thing is it's a privately held company, and when you see numbers, what's it based on usually? Because there's no market price, so what's it usually based on? most recent VC round, and I don't know what SoftBank is demanding in return for the 40 billion, but let's say they're demanding 5% of the company. So the way in which people come up with this estimated value for a private company is they take the 40 billion. It's like Shark Tank, right? 40% for 5%, that must mean 800 billion. I've always been a little skeptical, and most VCs who know the game are also skeptical of that scaling up effect. And here's why. We know VC investments are loaded with all kinds of options, ratchets that protect them if in case the pricing drops. So when you say I am investing 40 billion for 5%, it might be a bit of a lie because you're investing 40% for 5% plus all of these other options. You might be paying only 25 billion. Doesn't no, the value is still 500 billion. So extrapolating from a VC investment to the pricing of something is a dangerous game. But let's go along. Let's suppose it's worth 875 billion. The second part of the statement I think he said was intellectual property, not physical property. That's never bothered me. You can have, but let's face it, the greatest companies on the face of the earth are driven by intellectual property, right? Apple's most valuable asset has nothing to do with one infinity loop in Cupertino or the computers they sell or the plant they have. It's just the most valuable asset in Nvidia is its design capabilities. It doesn't even make it so. That is neither here nor there. Who cares? Ultimately, if it produces cash flows, I don't care if I can see it or not see it. And the third part I completely disagree with because it's difficult to value companies. You just paid 40 billion for it. If you're going to pay for it, you don't have this luxury of hiding behind it. So if your response to these companies is there's too much uncertainty, I won't invest in it, I respect that. But be aware of what it creates for you as a risk as an investor. Now, remember Warren Buffett's biggest, when he looks back at his life and people ask him, what's your biggest regret? He said, all these years I was Bill Gates was one of my best friends that I never invested in technology when it was young. I know they invested in Apple by the time it got to 2017, but he didn't buy, Microsoft in the 1990s or, Google as it was taking off. But the problem was it wasn't a bug in his system, it was a feature. Because his investing, and I'm not taking issue with it, was to buy companies which have much of their assets in place, they're generating earnings and cash flows that you could count on. And you could never say that about a young technology company. So if you're saying I won't invest in these companies because there's too much uncertainty, okay. But if you're a VC and you put your money in these companies and you hide behind this, that is nonsense. Because implicitly you put a number on the company. And what you're saying is, I don't want to make it explicit as to what I'm assuming. You know why? Because then people can see how unrealistic your assumptions might be. So if your argument is there's a lot of uncertainty, here's the thing to remember. It's not just you. Everybody looking at OpenAI faces the same uncertainty. We can't hide behind this uncertainty and saying it's difficult to do. And remember your statistics class. Just because something is difficult to estimate doesn't mean you can't put an expected value. It comes with a range or a distribution that's much wider. We have to think in statistical terms. It is true that valuing a Coca-Cola is easier than valuing Palantir. By far. Every person you offer that choice. But it's also true that the payoff to trying to valuing Palantir is far greater than the payoff to valuing Coca-Cola. Because anybody can value Coca-Cola. In fact, I don't even think you need a body. ChatGPT could value Coca-Cola. Okay? So when you think about investing, don't make uncertainty your primary worry because all it'll mean is you'll get stuck with mature or declining companies in your portfolio and you will now have no escape hatch.
Is that going to be the norm going forward? And I don't mean it as norm, but are we going to see less of 100-year-old companies like Coca-Cola, GE, etc., and maybe like a 10-year high growth, and then
Could be,
everything
right?
fizzles out?
It's not the norm. It might be more what drives the biggest companies of the 21st century, right? I mean, 21st century is century of platforms, companies investing. Now, businesses that used to be capital intensive, that took a long time to build, you're building in a much quicker time. I mean, think of how quickly Uber became the largest car service company in the world. Think of doing the equivalent in the last century. You'd have to buy cars in 1,000 different cities. It would be almost impossible to do. So technology has changed the game in good ways and bad ways. The good ways is you can scale up much more quickly now. The bad ways is you're not going to stay at the top very long because other people will find other ways to scale up and come. I mean, look, in one weekend, how much DeepSeek disrupted the AI story, right? So it does mean that and we benefited from the scaling up, right? Think of how quickly Facebook has gone from an IPO to $1.5 trillion company. That would never have happened in the 20th century. That's the upside. The downside is you could just as quickly go from 1.5 trillion to nothing. And that's got to be part of your investment philosophy is understanding. Now, I have a book on corporate life cycles precisely about this compression of corporate life cycles in the 21st century. And I think what happens is analysts are counting the good side with these companies. They're counting the scaling up, but then they're acting like these companies are going to be like GE and live for 125 years at the top. Now, that may be asking for a bit too much.
Yeah. I over a few months ago, I read an article on Motley Fool, which wrote about a Goldman Sachs prediction of a 3% return on S&P 500 over the next decade. I've heard you mention that individual investors with limited time should stick to low time intensive investment strategies, and S&P is one of the most popular ones. Where does this low rate of return prediction leave a safe investor? And what is your take on this? And how do you see the next 10 years of S&P 500?
You're starting with the presumption that Goldman Sachs has any idea what the expected return is going to be. You know how they get the return, right? There's no sage at Goldman Sachs who's sitting there predicting the return. It's based entirely on historical data. So what you do is you take, past returns. So think of a time series model. That's all they're doing. They're taking 100 years of stock returns. It's a version. Think of it as a slightly sophisticated version of mean reversion. Things revert back to the mean. You know how good people are at forecasting expected returns on markets over 10 years? How good is market timing? Horrifically bad. So you're framing a question based on a number that I have zero interest in knowing. So if you had given me that data and say you're more informed now than you were 2 minutes ago, I would have said it adds nothing to the conversation. I could have asked my doorman, and I will as I walk out today. What do you think the expected return on the market is? And you know what he gives me as an answer is just as much weight as Goldman Sachs because there's nothing there. Could returns be low for the next 10 years? That's a market timing judgment. If you want to make that judgment, that's fine. You can base it on, you can base it on data, you can base it on just gut feeling. And what should you do if you think returns are going to be low, 3%? Then it's not even low. Just put your money in T-bonds. You can lock in 4.5. This is not rocket science. If you truly believe Goldman Sachs, put your money in a 10-year T-bond, go back and live the rest of your life. And if Goldman Sachs is right, 10 years from now, you're going to look like a hero. So don't make things more complicated than they have to be. Don't assume that just because you see a name on a statement that somehow it has more weight. No. So I think that especially when you make these big macro statements about what interest rates will do or what stock prices will do, you do it for shock value. I mean, this is like a social media person putting on Twitter something that just pulls people to go look at the tweet. Goldman Sachs probably got a lot of attention for this statement. And I'm not saying that drove it, but that might be the only thing that comes out of it is a lot of people are reading it and hopefully nobody is acting on it because that would be a horrifically bad mistake because there's no there.
Is this something that the Wall Street sort of more frequently gets wrong about the market? Is that they just do a time series extrapolation and they don't quite account for that
It's not
cyclicity?
Wall Street. We all do it, right? It's called mean reversion. We assume things revert back to the average. I just read that Mike Scherzer signed, is a great baseball pitcher, won multiple Cy Youngs, amazing pitcher in the playoffs, signed with the Toronto Blue Jays. And if I look at his history, this is an amazing sign, right? They signed him for 1 year for like $10 million, a paltry price. See, how do you get one of the great pitchers of all time? His ERA is 2.3. He's one. The problem is, right? He's 41 years old or 40 years old, and he's not going to revert back to what he used to be. There's been a structural change. The problem with mean reversion is we assume no structural change in the system. Much of investing, not just Wall Street, much of investing is built on mean reversion. You know where the 3% comes from. If you think about returns for stocks being about 8 or 9% long term, you come off a few years of 20% returns. How do you get back to an 8%? You got to have below 8% returns. It's as low tech as that. That's basically what mean reversion drives. Why do we buy low PE stocks? Because we assume that over time they'll revert towards the industry average. It's an extremely lazy way of investing because you're assuming mean reversion works. And you have data to back it up. From the US, primarily in the 20th century. And I caution people, the US in the 20th century was the most mean reverting predictable economy slash market of all time because the US was the global economy. It controlled every macro force could affect it. If you want to live in the US circa 1971, that's what you think should drive investing, by all means, go do mean reversion. So when people use the Schiller P to say stocks are overvalued, they should be around, where the 16 times earnings comes from, looking at the P ratio for the S&P 500 from 1871 through 2024. Good luck with that. Mean reversion is lazy because it assumes things revert back. And you're not asking the question, has there been a structural break? Because if there's been a structural break, you will revert to a mean. It just won't be the mean that you thought you were going to revert to. Same reasoning with interest rates, right? Interest rates are going to go up. Why? Because historically, the average T-bond rate is X%. It's like the chicken, looking at the sky saying, the sky is falling, the sky is falling. One of the days the sky will fall and you say, oh, I was right. But just accidentally being right.
Yeah, it's like someone said, I predicted 18 recessions and I was right two times.
Yeah.
Uh, you also speak a lot about country risk when it comes to investing, especially in emerging markets. If I'm a solo investor, what are some of the things that I should keep in mind when I'm investing in foreign markets?
Things can change quickly, right? Depends on a foreign market. A foreign market could be Netherlands, in which case you're actually worried less than in the US. Your foreign market can be Nigeria, in which case you should be worried more. Why? Because just take a trip to Nigeria and look around at what Nigeria looks like, feels like in terms of risk. And country risk is not an abstraction, right? It's not a number. It's that stuff that can happen that can make something kind of melt away overnight. It could be political, it could be economic, it could be cultural. Those are the things that you try to bring into your valuation ex ante. And here's the problem. Where's all the growth in the world going to come from? The riskiest parts of the world. It's a trade-off you got to accept. So if you say, I don't want to deal with that risk, okay, you're going to be a domestic, in this case, a Dutch manufacturer, you're going to stay in the Netherlands and nice and safe, but there's no growth left. The market's kind of saturated. So I think the problem is the market, the parts of the world that beckon to us because they have growth also tend to be the parts of the world that are that are the most risky. And all I'm asking you is not avoid the risk, but bring that risk into your analysis because you can't complain about it afterwards. The good news is the two biggest markets in the world have become less risky over the last 15 years, China and India. And that's actually, China was the engine that drove global growth for the last 20 years. And the part of the India story, which has some weak links, the India story, is it will drive growth for the next 20. You can see why 1,300,000,000 people make a difference in terms of what you can sell and how much you can sell. So I think country risk is that reality check you put on yourself. Growth is great, but it comes with this check. I've got to bring it into my process. It's not fair to expand into India and complain about the slowness of the bureaucracy, the legal system doesn't work. You knew it going in. It is part of the process. You build in the expected cash flows, you adjust your discount rate for that risk, and then you try to do the best you can to add value.
Would you add, moving forward, would you add climate risks and also replenishment rates into the mix?
Well, I think climate risk is going to hurt some companies more than others. So by itself, I mean, if you ask me what does climate risk do, I'm not sure. If I'm valuing a Coca-Cola, I'm concerned about climate risk. If I'm valuing ExxonMobil, it's central to my question. To me, it's not the driver of the valuation in most companies, but it is the reality we face, right? So you have to factor it in. For the most part, will factoring an increase or decrease, it depends on the company. There's some companies that may benefit from climate risks and some that might be hurt. For everything that we think of as a bad thing, there's somebody benefiting. I give the example of the Russian invasion of Ukraine. European infrastructure companies had a big hit from it because many of them had to extract from Russia. But a Turkish construction company called Enka doubled its revenues in 2022 because they stepped into the breach. So when you think about the companies hurt by climate change, you might want to think about the companies that are helped by climate change. It's kind of you might say, well, this is a bigger problem. I don't want to think about mercenary. In investing, you have no choice but to think about mercenary effects. Maybe the makers of air conditioners are where you're going to invest your money in because the demand for them will rise because of global warming. You know? So I think that, you got to decide. But by itself, it's just a word, and I've got to figure out it doesn't matter in my company.
Interesting. We spoke a little bit about cyclicity of companies and how companies can quickly rise and fall. I just want to focus a bit more on the CEO of such companies. People who run the companies. Investors, a lot of the times they invest on what makes the company or a startup really promising. It could be the product, it could be the product market fit, and some people take a bet on the investor, or sorry, the founder and CEO themselves. Have there been certain leaders or CEOs that have impressed you? And I know you talk at length about how certain kinds of CEOs are right for the time of the company that it is in right now. So tell me a little bit about who have impressed you.
Now, when you think about evaluation is a bridge between stories and numbers, right? So basically, you're telling a story, connecting to numbers. When you're a young company, all you have is a story. There's no track record, there's no product, no business model. You're selling people in a story. So think about what you have to do as an investor to buy into a story. First, the person telling the story has to be a person that you think is credible. Second, they have to be compelling, right? They're pulling you into their vision. The nature of very young companies is if you want to think about who is going to run the company, you want a visionary. If you're a tech geek, you're going to have a tough time getting that company off the ground if all you do is keep describing the technology, how amazing your technology is. Because most of the people in the room don't even understand the technical details. So if you're an AI company, all you do is spend your time talking about the architecture of your AI processes. And everybody in the room is saying, what the heck is he talking about? This is not flying. You have to talk about how this particular product is going to change the world, change the market. You want visionaries as your CEOs. So you don't have anything else to show. You want the vision. But once you start to get money in, you need to build a business, a very different set of skills than selling people on a vision, right? You got to hire the right people. You got to put in structured processes. No. Once you built the business, you got to find new ways to grow. Different kind of skill set again, opportunistic. You're finding new markets, new products. And once you become a mature company, it's all about playing defense because everybody's coming after you. Again, a very different set of skills. Are there people who can play all of these different roles? Perhaps, but they're unusual. Most of the time, somebody who's an amazing CEO for a company that's a young company will very quickly find it gets dated, that they've reached a stage where their skill set no longer works for the company. That's why it's called there's an entire concept called the founder's dilemma, which is you're a founder of a company. If you're not capable of building a business, there might come a point in time where the business is worth more with you out of the business, somebody else running the business when you're running the business. It's a dilemma because it's your baby, your business. You want to keep doing it, But you actually might be worth 10 times more if you turned it over to somebody else who has the skill set to do it. It's one reason a lot of founders get replaced at startups by VCs is sometimes it's just sheer greed, but sometimes the founder is no longer capable of the phase that company is in to carry it through. So what goes into a great CEO is going to depend very much on where you are in the life cycle.
I mean, there's a lot of chatter about going back into founder mode. What is your take on it? It may not be the right decision all of the times, or
The founder mode basically means you're going to run everything, right? And it's a dangerous game to play because I can understand the control freak part of the process that says, I want to be involved everywhere. But you have to be careful that if you stretch yourself too thin, you might be not doing the key things that you have to do as a founder, right? So I do think as a founder, the part that I agree with is people who are founders who lose touch with what's happening in the trenches, don't understand what their salespeople are doing, what they're dealing with, what the product is actually modifying into, are at serious risk of losing control of the company. Yeah. So I do agree that these external CEOs who come in, the Chipotle CEO coming into Starbucks, and it's a dangerous game you're playing. So I do understand where the founder mode is coming from, but I think we have to be careful because otherwise you're going to stretch these founders to breaking point and beyond. And then you're looking at trouble for the company and the founder.
I see that the property ownership across the US, PE firms now own over something around 500K homes across the United States, and are expected to control 40% of single family rental market by 2030. Uh, this sort of large scale acquisition by PEs, thereby reducing available housing for individual buyers. How do you see this, and how do
There's
you
got to be
see?
another part of your story that explains the drop in housing. I can understand the 40%. So tell me why PEs owning houses mean fewer houses are available for rent. I mean, because it's an ownership change by itself. It's the same housing. Now PEs own it rather than the old landlord owning it. We'll talk about what part of the process is driving it, but you talked about a drop in housing. So tell me the other part of the story where PEs owning private housing is leading to a drop in housing. What are they doing that's removing housing from the inventory?
Uh, Not for renting, but for buying. Uh, they probably determine
So you're
when to.
saying they're buying houses that used to have homeowners live in them and they're making them into rental properties?
Yeah,
But
and then driving up the prices
but that has
because
nothing to do with PEs, right? So why are homeowners selling to them? Because homeowners have always had the choice of selling to somebody who'd rent their house. So are PE firms offering more than what those people would have offered? I think it's
probably.
easy to paint this bad guy, good guy, they're doing it. So I'm trying to dig to the what the economics of this, because if you don't understand the economics, you might be capturing just a trend which reflects macro changes where P's happen to be the vehicle that's delivering the change. What I'm talking about more generally is given how much real estate has gone up, many people, if you look at their biggest asset in their portfolios, it's the home they live in. You saying hasn't that always been the case? No, and you go back 50 years, a home was a part of your property, but your your earned income and the present value of your salary would have been an even bigger chunk. So as homes have become more valuable, it's also skewed portfolios of people into disproportionately real estate. The other thing is real estate has started to behave a lot more like stock and bond markets. There was a time, long time ago, when they moved in different directions. Now, if you have a good year for stocks, it's also a good year for real estate. It's actually, more correlated with financial assets. You took those two pieces together, that it's much bigger chunk of everybody's portfolio and it's more correlated. It actually would lead to an economic conclusion that people should be selling off that part of their homes having less in real estate because they become over invested in real estate. It's not providing the benefits of debt. So with or without PE, I would argue that you're going to see homeowners become more likely to sell to other people who are just investors in the real estate market and move on. Maybe PE is just stepping into the breach and doing. So it's not that there are fewer homes out there. It's just that there are fewer homes to buy because more are being rented. Okay? And so that might be a phenomenon where Ps are contributing. But why do you think Ps are able to do this ownership in scale that they couldn't? Why wouldn't they have been able to do this in 1981, you think? What,
I'm not sure, but this constant accusation against P's that they are, holding the property for longer, waiting for the prices to rise, and
we
maybe
all do. Come on. Greed is universal. How many people are sitting in their homes trying to sell it at a higher price? So to act like Ps are somehow greedy and the rest of us are these Mother Teresa's is completely missing the point. But here's why I think Ps are able to do this now that they couldn't have done 40 years. 40 years ago, if you bought 1,000 rental buildings in different parts of the country, even if you had the money, monitoring the rentals and the expenses would have been a nightmare, right? If you think about 40 years ago, this is before computers, each property was in a different city, the different manager. You'd have had to hire more managers, more. This again a place where technology might be changing the game. It might be making a business that used to be incredibly splintered, which is the rental property business, and consolidating it. What makes us think that that consolidation that's already come to online advertising, it's come to car, what makes us think that wouldn't come for real estate? Are there negative consequences? Absolutely, that we have to think through. How do we stop them? I'm not sure because the macro forces that are driving this is strong. Even if you ban private equity from ever buying a real estate property, the process is going to keep going, right? So I think we need to dig a little deeper at what's causing homeowners to be so willing to sell to private equity investors, why these private equity investors preferred to hold for rental income rather than speculate, right? I mean, would you rather that private equity investors bought your house from you, did a few fixes, and flipped it? Is that a better? So I'm sure you have to decide who your evil guy is because I think the second guy is probably going to create more negative consequence than the first one, where PE companies are buying a homeowner's property, then fixing the kitchen, they have the capital to do it, flipping it to somebody else at 30% more. Make up your mind on what the evil part of the private equity playbook is, rather than say private equity is evil, therefore everything they do has to be evil.
fair point. Professor, I wanted to get an understanding of because you have seen so much through life. I've heard you famously quote that you started to do valuations with a pencil and a ledger, and now we are. You saw through the internet age, the computer age, and now AI. Uh, how do you
You missed the smartphone and the social media age in the middle, right?
smartphone, social media, exactly? Um, how do you how do you educate or upskill yourself, and how has the world changed in the way they upskill? Because I've heard you famously say that you are a firm believer in thinking through problems yourself before seeking answers, and now we all can just ask DeepSeek or OpenAI and get instant answers. What does it do to our cognitive ability?
I think reasoning is a muscle, like every other muscle, right? If you use it, it gets stronger. If you don't, it gets weaker. And I think we are losing the power of our reasoning muscle. Why? Because it's so easy to look up answers. One thing to look up the answer to a question like, how tall is a building, right? There's nothing you're going to get by trying to reason your way to an answer. But if you're valuing a company and you say, what tax rate should I be using in the valuation? There is an advantage to trying to reason your way to an answer first before you look up the answer. Because it forces you to go back to basic. What am I trying to estimate? Why is this one number better than another? What are the different tax rates I could be using? I think that one reason I keep trying to come up with an answer on my own is first, I can look up an answer on Google, but most of the time I know enough about valuation that the looked up answer I get is either my own from some edition of my book to, or somebody else's, and it's not even the right answer. So not everything you look up is the right answer if it's a reason through answer. It's somebody's answer based on their reasoning process. And that's the point I make in my classes. I don't have the answers, but I can show you, I can open a window to my reasoning process. So I'll reason my way to an answer in front of you because I'd rather be transparently wrong than opaquely right. And people say, what are you talking about? Because if you can see every part of my reasoning process, let's say you took my Nvidia valuation from a couple of days ago. Every part I've tried to be transparent. This is what I think the AI chip market, this is what I think Nvidia will do. Because I want you to look at every part of the process and point to a part and say, you're wrong on that one. That's fine. We're talking where it's a healthy discussion about how big do you think the chip market will be, or what will the margins be. You know? As opposed to being opaquely right, where I say Nvidia could be overvalued by 30%. That's all I leave you with. What the heck are you going to do with that? The could be gives me an escape hatch because it basically goes up as I told you it could be. I didn't say it would be. The 30% is kind of a number. I could have been 30, could be 20. I could give you a range. What bankers do is it could be undervalued by 20% or overvalued by 40%. I'm not sure what I'm supposed to do with that. So I try to kind of see people or take people through my reasoning process because that's what I'm hoping to pass on. I don't have the answer for every question because I don't know what the questions in 2030 would be. In 2015, if you ask me what's AI, I'd have had no idea. 2025, it's a central question. 2035, what will be, who knows? But if I can pass on this reasoning process, when they run into that question in 2035, they'll be able to reason their way to an answer on their own. And that's what I hope they get out of my class.
Yeah. Do you think people should just spend some time thinking?
A
Uh,
lot more, a lot
yeah,
more.
more.
I think people keep asking me, what should I read? What should I watch next? And said, read less, think more. The only problem is, think more, you got to have an idle mind. And think about how much time in your last day, last week, you had an idle mind. Because when we have spare time, what do? We're checking our phone, we're checking our social media. We're filling every moment of every day with stuff. We keep telling ourselves, oh, to check my email. Do you really? Do you think the world revolves around you answering your email from 2 minutes ago? If that's where you are, you've really lost track. You've lost perspective. I think, in a sense, we need to go back to that idle mind. I mean, I remember standing in a bank line 40 years ago when banks actually had lines. And while you stood in the line, what do you do? Absolutely nothing. 25 minutes of doing nothing. You think that was a waste of time? And not really, because when you're doing nothing, your mind gets a chance to roam. And your biggest connections often happen when your mind gets a chance to roam. I just as an analogy, I say, imagine Newton sitting under the apple tree, checking out his iPhone, and the apple had fallen on his head. And think through what would have happened then. He'd probably been pissed off because he was checking Facebook. And he was in the middle of this really interesting post from somebody he didn't know. The apple fell on his head. He probably threw the apple to the side and went back to reading Facebook. Thank God he didn't have a smartphone. Because we got the laws of gravity from an apple falling on his head because he said, why did it fall down rather than go up? And that gave rise to one of mankind's big discoveries. So I think that we need to give ourselves room to just think. Take your dog for a walk, but don't take your iPhone with you. Or don't check your iPhone while you walk your dog. Just think about things. Let them kind of bounce around. Some of the time you'll come back and there's nothing profound that happens, but sometimes you might surprise yourself.
Yeah. And now that you say this, it makes me wonder, you know, we had this great time in the 80s and the 90s and maybe even before that, where people would think about there was so much diversity around the world. And uh, and then we generated so much data and started to think less. Do you feel like, it's all gonna plateau because everyone will learn from each other but not generate anything new
Well,
in the
plateau
process,
in
and then
what sense? If you've lost your reasoning muscle, remember evolution is magical, right? If you don't use something, what happens to it? You lose it. I'm worried that 40 years from now, if we stop losing our reasoning muscle, when babies get born, they might be born without the reasoning muscle because they may be born with a smartphone and Google search attached to them. So my worry is evolution works its magic. We might end up becoming unable to reason. We're setting ourselves up to be replaced by by our bots. Each of us has a bot looking over our shoulders. We're just begging to replace ourselves. And if you're a conspiracy theorist, you could argue that what technology has provided us over the last 20 years has made it easier for a bot to replace you than it would have been 20 years ago, 40 years ago. So I'm not suggesting times were better in the 80s and 90s, they were just different. And I think that, and you could argue that people in the 80s and 90s had the same issue with us, right? They said about the amazing things you learned from the tactile feel you got from typing on your
typewriter.
typewriter, and the people who got typewriters were probably told you should really use a fountain pen and write in cursive. In each generation, we lose something because of progress. And the question is, we've seen so much progress, and I'm going to put quotes on this in the last 40 years, that what's different is we're losing things in hyperspeed. And I'll take an example. I can't read a physical map well anymore. Why? Because GPS has removed the need for me to look north, south. Because right, you take a physical map, first you got to make sure you got it pointing in the right direction. Or you're going to be driving in the wrong direction. I don't have to do that with GPS. It automatically orients itself. It tells me where to go. And I wonder what will happen if that. I mean, there's probably going to be a point in time where people will not be able. And saying, so what? People can't read. At some point in time, I guess people had to look at the stars to decide, what the sequence is, what direction to go. So some of this you would say, who cares? But I think the reasoning muscle part, we better be careful because if we stop reasoning our way to answer, we won't be able to do it anymore.
Hmm.
I mean, I worry about my kids and grandkids. My kids less so, my grandkids, because they're going to come into a world that's very different from mine. But looking up things is going to be, I mean, they don't even need to open Google search. They just need to ask Alexa in their house.
Do you have any tips for parenting for people who are recent fathers and mothers?
Yeah.
The sense of delayed gratification and the delayed access to technology.
The only thing you can do is reason in front of them and show you enjoy the process. So when they ask you a question, rather than looking up the answer yourself, try to reason your way to an answer and do it as if you enjoy the process. Because then they're going to say, he looks like he's having fun reasoning his way to an answer. Maybe I need to do that too. So I think we need to, rather than tell our kids not to use their smartphones or take it away from them, we need to, I mean, the people who are telling their kids to do this are looking at their smartphone while they're doing it, right? It's hypocritical if we keep doing this and, it's, we're telling them not to do it. So I think we need to model for them what reasoning looks like.
Perfect. Uh, well, before we end this podcast, I just want to quickly touch on the Nvidia valuation. You had valued Nvidia around mid to late 2024 at $87 a share, and in one of your recent videos, you had brought it down to 78. Uh, what makes you not so optimistic about the market cap of a company that is supposedly a sole player in the high
Nothing to do
performance?
with my values, nothing to do with market cap, right? That's the other side of the equation. It's really got to do with, what the potential market is, what the growth is, and a weekend can change that. And that's basically what happened. DeepSeek changed because what DeepSeek did, and if you cut it down to basics, it said, look, you don't need to invest in really expensive AI chips and have immense amounts of data to be an AI company. In hindsight, we say, I knew that already, but did we? Until last Friday, that seemed to be the rule book, right? That Meta and Microsoft were spending tens of billions of dollars to enter the business. And DeepSeek has all kinds of questions we still haven't answered, right? How did they come up with it? Did they actually use Nvidia chips to get there? Did they actually spend, the 5 million or whatever they threw out was a complete fiction. They probably spent $1 billion, but $1 billion is still cheap in this business. Even if DeepSeek turns out to be a fraud, which is what OpenAI is claiming, that was just they stole the data, they've changed the net. It's like the emperor's new clothes, right? If the AI emperor, until last week, people didn't even dare to question, do you need AI chips? Has sprung a wardrobe malfunction, as I would say it, because now you're saying, do I really buy into those parts of the story? I'll give you an example. Yeah? I've had people, I don't formally consult, I don't formally work with companies, but people, they come up with new products, check out, do you think this will work? So for 20 years, people have been offering these automated accounting products where you take the IFRS or GAAP. So even before it's called AI, so let's suppose you're developing an accounting AI product that'll do fair value accounting. You know what? I know that business. It's entirely rule based. You don't need any data. You don't need to know how every accountant in history has accounted because it makes no difference. And you don't need high power. This is low power stuff. So even at the height of AI, I said, why would I need Nvidia chips and every accounting statement ever made to do an accounting statement today? And what DeepSeek did was, you don't need it for that. So there's going to be a segment of the AI market which is going to be, I called it low grade in my post, but people took that as an insult. Low intensity products you can develop. And it's going to change that market. It's going to be commoditized, lots of competition. There's going to remain a segment, call it the Palantir segment, where you need AI, where you need the powerful chips and the data because you're trying to do intuitive stuff rather than rule-based stuff. So not that the market has disappeared, but it's become a smaller market. That's what caused my value to drop is I think you went from all of the market to a segment of the market. And even if you dominate and earn high margins, you're still less valuable than you were. But remember, even at 78, I'm giving it a $2 trillion value, right? Let's talk in terms of numbers. And people say, why are you so pessimistic about Nvidia? A $2 trillion valuation doesn't come out of a pessimistic story. It just comes out of a story that's less optimistic than the one you're telling.
Perfect. I think there's a good lesson to be learned here is that, you don't have to use AI just because you have it. And there's a fine line between over engineering and doing what is right. Um, Professor Damodaran, thank you so much for your time. And I could have asked so many more questions, but we'll keep it for another time. But it was absolutely great chatting with you.
Thank you. Appreciate it.
Yeah.